Welcome back to BizMafia, where business gets made. I'm your co-host, Brian Taylor, joined always by my other co-host, Pat Linden. Pat,
What's
how are
up,
you?
my man? I'm good. You?
Good, pal.
Good.
I think there's a little tell that the audience is going to start to pick up on, and that's anytime you do the overview and intro of our guest, generally means you have a very close relationship with them. So why don't you tell us a little bit about our next guest here?
Very observant of you. So, no, typically the way we do the intros here, Brian, is kind of he's the Johnny Carson, and I'm kind of the sidekick, And
Not true, Pat.
We like it that way.
Not true.
Every so often we have somebody where I've got a close history with, and that would be the case today, which is Pete Oberle from Trailhead Capital and a Denver native originally. We'll talk more about that, but got a great show in store for us, right? Pete is originally from, I think, Inglewood or kind of Denver metro area, Cherry Creek graduated from Dartmouth. Get a little bit more on that later. Started his professional career at Robert Stevenson, which was a kind of a bulge bracket, very well-known investment bank at the time, doing IPOs. This is in sort of the late 90s IPO craze. Came back to Denver for a couple of years, worked for Daniels and Associates, which was a well-known boutique investment bank back in the day. Then he goes to Wharton, the University of Pennsylvania, gets his MBA. He's one of those guys.
Underachiever.
11 years in real estate private equity at Rockpoint Group, which has $80 billion under management. He was a managing partner there based out of Boston. A few years as a managing director at Frio Group, a European real estate and private equity investment manager. That leads to 2020 when he starts Trailhead or becomes a co-founder of Trailhead Capital. Great story. We're going to let him tell that.
Yeah, there's a lot to get into with him. And this is one of those guests that I honestly wish there was more time. One thing that was really appealing to me, and I'm not going to give away too much, but it's definitely something we'll bring up in the episode, is his time that he spent in Japan, where he started to really focus on CrossFit and dialing in the paleo diet. Within that, he goes down the rabbit hole of the food system, right? And starts to uncover some things that becomes really interesting and then correlates to where he presently is within his career. So won't give away too much there either, but it's a fantastic guest and interview ahead. So
yeah, and then I think, Brian, one of the things I'm really looking forward to is you're talking about a highly sophisticated financial person with sort of the best conceivable experience you could have. And now he's a principal in a early stage VC fund. So kind of what is the best practices that he took from that prior life and what did he have to forget, right? And relearn. So it should be interesting. Should we bring him on?
Yeah, let's bring him on.
Pete, welcome to the show, bud.
Thanks, guys. Great to be here. Good to see you.
Good to see you. So before we dive in fully, I'm going to give a little personal history here because you and I go way, way back, right? So, you actually from Denver metro area, Cherry Creek guy, you were kind of like Christian McCaffrey type lore of truly high school football back in the day. And the audience will find this interesting. How I know this is that Pete was a year older than me. And I first saw him and learned of him in football. He played in the state championship, Cherry Creek, 1991. I was a junior. Pete was a senior.
Right.
I think you guys played Arapahoe. And it was like the Stutler Bowl, and it was all snow. And Pete scored a few touchdowns. They won the game. And I remember reading the next day, it said, Pete Oberle soared through the icy tundra of the Stutler Bowl. And then I remember, Pete, you got recruited by a lot of schools. I mean, you actually originally went to CSU. This was back when CSU was like in bowl contention every year. I think you got recruited by CU. You were a commodity, man. And I was just bummed that I didn't get to play that game. I was like, I'm going to stick that dude, But I got my chance because then later I ended up being recruited to play football at Dartmouth. And then it turns out, even though Pete had done very well at CSU, he's a very bright guy, and he decided to transfer there. We got recruited by the same coach, Pat O'Leary, came in the same year. Pete, you were a meaty guy back then, about a solid 225. This whole paleo thing, I feel like I can give you a few nuggets. It's like, hey, 20 years later. But anyway, man, it's great to have you on. We obviously have that connection, and you've gone on to do amazing things. We can't wait for the audience to learn about that today.
Oh, man. Thank you. That is far too generous a background, but I'm glad you're not the only one. who has, for me at least, I get better. The older I get, the better I was. So I think that has.
I don't know anything about that.
Well, you left quite the impact on Pat back then and today. And, as we talk through the intro, there's, a fair amount of accolades and accomplishments we sorted through. And I was joking, you're a bit of an underachiever, right? But, currently, can you what led, right? And it's a lot, but what in essence led you to Trailhead and being a co-founder and now you're managing director there? What led to this point? And then could you just kind of dive in and give us kind of the 50,000 foot view of Trailhead? Maybe start there.
Sure. I guess, the quick background, which I understand you've touched on, is really, I've been in finance investment for 25 years. So far too much finance and investment, but started off in life sciences and ag biotech, went back to business school, spent 15 years in private equity. And along the way, that's right, stumbled down the CrossFit and paleo rabbit hole because I was trying to fix everything I broke playing football and finding ways to reduce inflammation and just, make my body feel a little bit better. But the more I learned about paleo, the more amazed I was at how my understanding of the food system was just backwards, and I became that guy who was getting monthly blood tests to track my biomarkers because I couldn't believe eating meat and just focusing on fat and minimizing carbs was going to move everything in the right direction. But it was. So, I continued working at the private equity fund that I was at, but I started angel investing in the space just because I knew I wanted to get more involved. So started off investing in high-end CPG companies, pulled that thread a little bit more, wanted to understand causes of inflammation and ramifications from it. So I invested in some gut microbiome companies. And, tracing that further back to the source, I started looking at farmland and came across regenerative agriculture. And really, when that happened, the light bulb went off in terms of regenerative agriculture's potential to address so many of the crises we face today. Basically, it can improve climate change, human health, move from a large source of water use to a better steward, and more broadly, even kind of move away from centralization to a little bit more regionalization, localization, and hopefully strengthened connectivity and community. So I did take a year off at the tender age of 42 because I realized maybe private equity wasn't everything that life should be, and spent a year going around the world. But I came back more motivated than ever to contribute where I thought was most important. I'd come across regenerative agriculture, like I said, but tried to incorporate that with some prior skills. So initially opened an office in New York for an asset manager in Europe, ended up building a team and a platform of about $200 million. But it proved difficult to layer on some of these more sustainable practices and technologies. So made the decision in 2019 to really start investing in regenerative agriculture full time. But the forces that be actually reconnected me with an old friend from high school who was essentially pursuing a parallel path. His name's Trip Wall. He had been deep in the space, investing in organic grocers. And he had been talking to a few people about institutionalizing their efforts with a early stage fund. A couple of those other partners were Bobby Pells, who's based in Boulder, started McDonald Pells 40 years ago, which is now the largest independent grain brokerage in the world. Wow. And another, participant in the space, Mark Lewis, who had been investing in climate energy efficiency and had bought a farm and converted it to a regenerative agriculture operation. So looking at all four of us, we thought, having somewhere between 10 and 40 years each, the space, we could really launch a platform where we thought capital was most needed to move the space forward. At the time, and we still see it as the opportunity, it's in the early stages. It's some of that greater risk capital, call it seed, Series A stage companies that need that. There is, fortunately, a lot of capital out there in farmland and some for, say, later stage CPG companies, but there's not as much to really help a lot of these brilliant ideas go from 0 to 1 and have some huge scale change potential. So, yeah, we launched that We started talking about it in 2019, launched in 2020 officially as COVID really accelerated things. And truthfully, that served as a benefit for us, gave us the opportunity to raise funds virtually and provided some tailwinds as people started paying more attention to the food and really the challenges of the food system overall as food shortages actually happened. Today, we're focused on seed, Series A, regenerative food and agriculture companies. To be clear, these companies are providing tech-enabled solutions to expand the practice of regenerative agriculture and improve access and affordability to regenerative products. So that can mean a lot of things. Ultimately, we're trying to solve for soil health and improve that either directly or indirectly. And we try and invest a little more upstream. That is, not so much at the consumer end, but at really the on-farm level and through the supply chain. That's where we think there's really potential for systems level change and impact and a greater lever to improve the system overall. So it's a $50 million fund right now. We've made 25 investments and ultimately see that portfolio rounding out at about 30.
Yeah, that's great. That is fantastic. And the three of us have talked about this at length, but it's really interesting. You were ahead of kind of this trend, right, of the biohacking, of getting into the microbiome, gut health. And it's interesting from that starting point and what your journey looked like to get to this present day. It's a great journey. One that's certainly just beginning, but it's something that I'm also very passionate about. So hence additional excitement for having you on.
Yeah. So Pete, I was going to get to this at the end, but I think kind of the way you hit it, I want to dive in now a little bit, which is you said you retired or semi-retired at the ripe old age of 42, or maybe you just took a trip around the world, but you've worked, we said this at the beginning of the show. I mean, you're a Wharton grad. You've sort of, I'm gonna beat your drum a little bit. I know you wouldn't. I mean, there is sort of no better finance experience than what you've got at a variety of different, very high level things. We're talking $1 billion deals, a lot of money going around. A lot of people would want to be in that position. What led to this sort of evolution because private equity is dramatically different. I would envision versus VC investing in the sense that typically you're buying established businesses and so forth, and you are actually in real estate private equity. So a lot of commonalities in some ways that I'm sure are very helpful. Other ways, I'm sure you had to think differently, but the journey, what was the kind of the metamorphosis of, I'm going to give all this up and this is what I'm going to do?
Great question. It was, I guess, thinking back to, around that time where the thought or the possibility of leaving the firm I was at started to, the idea started to percolate and seem like more and more of a reality. I guess it was always feeling like there had to be more. And, I didn't know what more was for the longest time. I mean, don't get me wrong. There was much further to climb at the firm. But, I think that's the nature of a lot of private equity firms as well. They kind of have only a few seats. So there was some consideration that okay, it's going to be a long time and I didn't want to wait around for one of those seats to open up. But in some ways, I started to realize that there may be ways to more effectively contribute to improving some systems out there. And truthfully, I think when I stumbled down that paleo diet rabbit hole, it just improved my passion for improving human health. And the more I learned about it, I saw that, I also appreciated the challenges. This was me who was spending a lot of my time trying to figure out the right thing to eat. And it was incredibly difficult. Yeah. So that improved my sympathy for those who are facing chronic illnesses out there as well. And the more time I spent in the space and the more I learned about regenerative agriculture, well, it opened up to my eyes to the challenges that it's addressing and, made me more aware of the need to give those some thought and attention, but at the same time presented a tremendous opportunity, certainly not a panacea, but one with a pretty broad reach to be able to address a lot of those crises. So it just continued to pull me away from, as you said, it was private equity, which was great. I mean, the initial thought getting in there was you could invest in these projects that ultimately could do community building on their own. But surprise, and this shouldn't be that much news to plenty of people that are listening to this. I mean, private equity, you're trying to turn these projects around in 3 to 5 years. And obviously, it's heavily profit oriented. Not to say that's zero sum, but there could be greater levels or levers for improvement that provide clear win-win opportunities for everybody involved. Of course, the last 15 years or so have been pretty crazy. As you know, there was free money in the ZERPS environment. There were a lot of startups reaching incredible success. So I was also wary of that coming from private equity, knowing that always having in my mind that this time is not different. But as I, was angel investing in the space, I continue to recognize the potential for increase and amplified improvement in the system. And it also seemed that the momentum was building in the space, in that really the ag tech market accelerated about 10 years ago when David Friedberg's Climate Corp sold to Monsanto at the time. And that kicked off an acceleration of investment in the space. But it continued to dawn on me that it was at a very good inflection point where consumer awareness was driving corporate commitment, and technology had moved far enough along that it was going to be affordable to invest in these companies and this company building to move at the pace necessary to deliver these technologies.
So, Pete, there's a point where your passion, right, takes over. You go down the rabbit holes we've discussed. The term, there's riches and niches, and the phrase highlights the potential profitability and advantages of specializing in a specific or well-defined segment, right? But passion can only take you so far. So as you're going through this journey, how did you evaluate the space to determine if there was a financial play and upside here?
Yeah, you caused me to rewind a little bit here. I think some of it goes back to, there is kind of a big picture consideration with the realization that it has the potential to improve every one of those elements. When I say those elements, again, I'm thinking of, climate change, move from, a carbon source to a carbon sink, biodiversity, transition from collapse to reinvigoration, go from a water user to a water steward, go from, food as poison to food as medicine. Just those big picture potentials to really improve those elements. Okay, you can see from a distance should have outsized economic return potential. But you're exactly right. Then you have to, so you take it from the top down level, drill into it. Okay, what are the frictions that have held it back historically? And why hasn't this been the case to date? I did come back to one of the points that I just touched on, and that being at a bit of an inflection point where consumer demand and actually the ability to inform consumers of the differentiation had arrived. So hopefully you could get over some of the hurdles in the past where, companies, big food companies were able to fall back on more commoditized foods. But again, another question being, can the historical friction of capital intensity and duration, the long time to iterate for these companies, actually be overcome? Yeah. Felt like technology had moved far enough along to really accelerate some of those considerations. And admittedly, thought we could also approach that with a bit more diversified strategy. That is, like, consider stuff that's on farm and then those that are in the supply chain. On farm is a little bit more susceptible to those frictions in that, you're dealing with incumbents who present a lot of the ultimate exit potential, but it also, you're dealing with one iteration a year with every harvest. Move that to the supply chain, and there's a lot of opportunity to iterate and improve some of the functionality of it today.
Do you feel there's a more sophisticated consumer today than maybe there even was, prior to 2020? And do you think, you brought up the fact that 2020 did a lot as far as, look, it made, your conversations go virtual. But I also feel like you touched on the supply chain. There was a bit, people started to focus on the issues with supply chain, but I feel, and again, this is you're in the space, so you would know best. But I feel like it was only fairly recent where I started to really understand microbiome and gut health, right? For example. And then for me, it took me down the path and my wife down the path of understanding where our food is coming from and what is put into it and everything else. So do you feel like the consumer is more sophisticated today, or is that just because I'm currently in it? That's my belief.
It's a great question. We got to check ourselves on that all the time. But
yeah.
I think the answer is undoubtedly yes, but it's still hard to distill all the information down into the right answer. I mean, I think of the, whether it's millennials or the generations after, it's almost a given that, they are giving consideration to everything they buy and how sustainable or not are they. So we continue to be encouraged by the attention there and ultimately think, of course, they're going to be the drivers of consumption. But yes, there is the ability for every consumer to know more. I think there has been a historical intention to obscure some of the information in the food that we consume. Some, not to say there's any nefarious activity out there, but, I think it just sells better without getting into a lot of the details. But there is, companies have more channels to market through and better opportunities to explain the pros and cons and generally the merits of the product they are delivering. So I think that necessarily improves the understanding of the food and, greater detail in terms of the quality. But that is certainly, a company we're investing in right now are still trying to do specifically that. We want to decommoditize the food industry. So again, improve some of that transparency and traceability to be able to differentiate the quality of foods, but it's hard.
Yeah.
So Pete, given us a pretty good perspective, I think, on you're passionate about it and you understand the economics and finance and those kinds of things. But early stage investing is hard to begin with, and you're in this particular space. And obviously, you've got to believe in the play and all the things that you talked about. And I like what this company has and can do. You talked about duration. So what does the kind of day-to-day look like when you're putting this money at play? And meaning, what are you looking for in founders? Because it's tough enough as it is in venture capital, let alone if you're kind of in a new space and figuring things out as you go. You have to get outsized returns. You don't have a full capital stack. How do you make all that work? And what does the day-to-day look like between you and them? And what do you look for? And what do you bring to the table that they don't have as an advisor investor?
Yeah, a lot of considerations there. I guess, on a day-to-day basis, right? I guess the initial stage is really filtering some of the opportunities that are coming in. Because, we're seeing, again, given some of the channels that are available out there, I would imagine every one of us that are trying to invest at Trailhead must see, I don't know, anywhere between 25 and 50 investment opportunities a week. So that the filter is applied for us, just trying to solve for regenerative potential there. I touched on that a little bit before, but bottom line, there are some of those characteristics that we filter down, right geography, which is generally North America, Israel, and Australia initially for us, regen characteristics in terms of systems level change potential and ability to improve soil health. But then, stage and traction to date. But, we can dig into those a little bit more, but hitting on your specific question about, founder characteristics, there's some of this may be cliche for plenty of those who are familiar with the space, but it's, there's always the why now question. And we also have to be wary of that because a lot of these opportunities feel like why now is a pretty clear answer given our mission orientation and our bias to see the opportunity for regenerative agriculture to have an outsized impact, but still solving for that for specific companies and their technologies. Is the market really ready for what this founder and executive team is presenting? But again, specific to the founder, there's founder market fit. Like, is this something that somebody was just like looking for a problem they could solve, or do they really have, that personal experience and background that, lit the fire of passion to really pursue this? And is it something they're absolutely going to want to be doing in 5 to 10 years? Because they shouldn't expect for it to take much less than that. It can, but I think we all know it. That's that's the less common outcome. I think we've been reminded in recent years that capital discipline is important. I shouldn't say I'm listing these in order necessarily, but I think that does speak volumes in terms of, how they're thinking about the company. And I think, as has, we were reminded in recent years, like, too much money is generally not a good thing. So the ability to kind of start with limited capital can serve as a forcing function to be as creative as possible and as resourceful as possible to move that company forward. And it's always a lot easier to go from limited capital to more capital than the other way around. I come back, and this could be a bit of a generalization, but I certainly want to test for their ability to execute. I know, I just come back to the feeling that ideas are a dime a dozen, and, 90 to 99% of getting these companies to the right place is following through with that idea and executing. So
experience in some, even if it's not the same thing, but a successful track record would probably be important, I would imagine.
It goes a long way.
A heavy part of the criteria.
It goes a long ways in helping, but admittedly, the companies we're investing in, there's some traction. We're looking for some revenue being generated, or, it's important to qualify. We're investing in software, hardware, and biotech companies. Little harder to be revenue generating for hardware and biotech companies sometimes at our space, but you can see trial progress, and, overall you can look for revenue progress, but you can see the systems that they've put in place and how they are thinking about the roadmap ahead that can provide some encouraging signs in terms of their ability to execute. But yeah,
as you said, that's the $1 million question: is how do you vet, the ability to execute? And I think that's a good kind of indicator. But I'm sure there's some other things that come into consideration that you either ask or look for. Or do you go through kind of examples or case studies? But that can be difficult if they don't have much of a track record too, right? So
it can, I guess, sometimes it's working through the opportunity at hand. And we are constantly blown away by, the brilliance of the folks that we're talking to, but really thinking through what that path is going to look like going forward. I will step back from that and also recognize inevitably the vast majority of these companies are going to pivot. So you also want to try and work through their ability to deal with adversity and to remain resilient and to get back up after having faced some of those challenges. Again, it can be early, but you can, in some of those initial conversations, get a sense of those experiences that may provide some parallels prior in life to provide some direction on that. Oh, the only thing I was going to add there, just in terms of like mapping out the market, and I get plenty of pushback from this coming from, a little bit more of the private equity space, doing it at our stage. I gain the most insights, at least for the initial proposed path for these companies, with a financial pro forma. I'm not holding anybody to those financial milestones necessarily, in just the first couple of years of existence, but like, have they thought through how all those pieces in the puzzle fit together to really map out a potential path to some of those massive outcomes?
I'll ask a question, Pete. We talked to a different private equity investor, I should say, who talked about the importance of strategic planning. And I'm curious, given a much bigger limit in resources, given the investment stage and all that, I've got to imagine you sit on, I think, 6 boards of portfolio companies. Did I see? Is that accurate?
It is.
Okay. I imagine you're pretty active. And what is your viewpoint on the importance of strategic planning? So that's part one. And part two is, how involved are you in sort of overseeing that? And what are your expectations to see after you've made an investment? Take us through that.
Yeah. Well, and of course, the cop-out answer is it depends. That
I'm a lawyer, Pete. I get it.
That's great. It's wherever
always
reasonable.
Come back to that.
There's some commercial reasonableness here, Pat.
Right.
It does depend. Some companies need more hand holding than others, and some just want us to stay out of the way. I would say that, well, this I know goes back to a question you asked earlier, but I think it dovetails here in that, like, what are some of the, elements we're contributing? I mean, at a very high level, yeah, we'll touch on strategic planning. So I put that in kind of an advisory category. Yes, these companies ultimately want us to help them raise capital in the next round. They'd like us to help them find customers and talent. And you can imagine in every one of those categories, there could be varying degrees of assistance needed. But to your point, I think that is so critical. And yeah, an essential role when holding some of those board positions is keeping in check some of that strategic planning. Again, a lot of these companies have tremendous plans in place and are doing a great job on iterating and executing on those plans. And sometimes the biggest task at hand is just helping maintain focus. That is, one of the great challenges that so many of these companies face is so many opportunities coming at them all the time.
Shiny object syndrome.
A lot of shiny objects.
Right.
We are subject to it too. I should have thrown in there at the beginning. Make no mistake, we are a bit of a startup investing in startups. So we constantly have to remind ourselves of that, but hopefully it helps us put ourselves in the founding team's shoes. But that's right. Some of the strategic plan is, one, making sure whether or not the potential, the pros and cons of each path are considered, and where can we offer insights? Maybe they're trying to sell to enterprise customers. What are realistic timelines and challenges faced with some of those customer approaches, or where can we help with some of those? Plenty of participation along those lines to help keep these companies executing on the plans that are agreed on up front. That said, of course, it depends when you are getting involved with these companies, and board count can vary just in terms of representatives at the seed stage. I mean, quite often it's 3 people. It might be 2 investors and an executive team member, and you kind of move up to A, and it might be more like 5 members. It's important to remember the investments we're making are minority and minority holdings. So we may have a vote on the board, we may not, but of course it's only 1 vote as opposed to a controlling position.
But I would imagine that there's some protective provision stuff that you work into every deal,
There is. But yeah, ultimately, of course, it's just one seat at the table, 1 voice in the room.
So going back to that, I want to get your perspective on what makes a good board member for kind of a seed level company. And I know that it can depend on the situation. In some situations, if you've really got it together, and I imagine being a good board member is you go, I'm going to get the hell out of the way and just let them do their thing. In other instances, that's probably not the case. It might be, I'm going to help you source more funding or whatever it is. But by and large, so I have a lot of early stage clients, and even if they control the board, if you will, because it's an early stage investment, your investor can still make your life very hard. Even if they're not legally in control, they could have unreasonable expectations on sort of exit and everything about the whole business, right? They can make your life a pain. So I'm curious, Pete, what would you tell these types of companies that they should look for in their early stage investor and a board member, even if not controlling?
It's of course, as you're walking through that, and I guess it wasn't that long ago that I suspect you and plenty of your listeners probably witnessed the board challenges at OpenAI. So, right, that's a great example of where, a challenged board structure could present some issues for the company. And all of what I'm going to say, I'll qualify with encouraging everybody to read Brad Feld's book, Startup Boards, if you really want to know some of the best advice and dynamics to consider within boards. We're very fortunate to benefit from Brad's partner, Seth Levine, as one of our key advisors, who's constantly providing great direction along these lines. So most of what I say will hopefully accurately reflect what they've taught us. But I think some considerations there is board diversity. I mean, admittedly, a founding team isn't going to want all investors on their board. Each round lead is going to want some representation there. But, consider mixing that with some independent product people and, also some independent voices to provide a diverse perspective on being able to do the right thing for each of these companies. How many company representatives are on each of these boards? It can vary. I mean, I generally expect to just see one, and that is the CEO. But sometimes that can have a few more representatives, and sometimes that can help continue to narrow the focus and provide the necessary direction for the company. But yeah, at the highest level, board diversity is helpful. Investors
as we were
and
talking,
operators.
sorry there, Pete. As we're having this discussion, I just kind of see this differentiation and value that you add to every portfolio company, and that, in my mind, is, again, back to being niche or specialized. You know the industry really well. And with that, the big picture, right? And I would imagine that's got to be attractive to a company that you're investing in, is to say, look, we might cover one segment of this market, but our investor kind of sees the big picture and this whole ecosystem. Am I onto something there as far as that differentiation goes?
Absolutely. I think that's been a very conscious consideration for us in terms of investing in the verticals that we do. The ability to see both those opportunities or other companies that are upstream or downstream from a particular company that we're working with. And, fortunately, as a result, a lot of the portfolio companies can work together. And again, plenty of people that are involved in the early stage scene can appreciate this, I'm sure. But that is one thing that continues to stand out and fortunately play out. We see it in our portfolio and elsewhere, and that is the collaborative potential and activity between portfolio companies working together upstream and downstream.
That's a great point. It would seem like there'd be a lot of cooperation because that this is capital intensive and you're not going to fund it all. So you need other investors that you're aligned with, or maybe there's going to be deals that they don't like that work for you and vice versa. I'm also curious, Pete, what does it look like when you're having a conversation when you've found a company that checks all the boxes, right? Mm-hmm. Leadership team, you love the idea, they've been pre-screened, all those kinds of things. What's the financial horizon and the timeline when you go, look, if this all works out, it's a 10-year endeavor and it's an IPO, it's a 5 to 7 year endeavor and we're selling to a institutional company in the space? Or what does that conversation look like?
Yeah, certainly one we have prior to every investment. And
imagine.
But it's...
it is an investment, right? It is an investment.
It is.
It's not play money.
It is crazy. Of course, we know some of the craziness that occurred in the market in recent years, and you're reminding me some of the stats out there. And this does feed into your answer. The need to be realistic. Of course, like thinking about VC investing and, the unicorn became the focus of ultimately that's what you want to be investing in. The stats I've seen recently is, it's important to keep in mind there are 343 companies that are trading at over $1 billion in public stock markets. There are currently 1,400 unicorns. Half of those were funded between 2015 and 2022. 60% of them were funded by 4, late stage investors who are not quite as active as they were a few years earlier. So that's going to change. And more specifically to your question, in this space, we're trying to be realistic about not underwriting to $1 billion outcomes. Yeah, absolutely. That would be tremendous. But I think, more likely the outcomes are going to be less than that. Anywhere from $250 million to $1 billion could be very good outcomes. Of course, that depends when you're getting in and what that investment basis is. And oftentimes for us, that's somewhere between $5 and $20 million in valuation. But that exit, it's it'd be great if there could be a public market issuance. But yeah, the vast majority of outcomes within our space have been through acquisitions. So we are giving that consideration and making sure that we have some historical precedent to justify some of the outcomes we're anticipating, and making sure that universe is expanded enough. Oftentimes, that's a little more limited for the on-farm opportunities, hopefully more expanded to potentially financial and tech buyers in the downstream supply chain, fintech, or digital infrastructure spaces that we play in. But to your question about duration, yeah, that is one element we are trying to add here. I mean, admittedly and understandably, a lot of traditional VC funds may have shorter timelines. I mean, the reality is, I think the average fund life at the early stage has increased to somewhere between 13 and 15 years. I mean, realistically, we think some of these companies are going to find, some liquidity in years 7 to 10. That's the duration we're planning for. But the other element is really how much capital is it going to take to, achieve the targets that they have in mind. And there are varying paths there.
So, Pete, I want to spend just a minute, because you are a VC, and I think this is an important question that always comes up, which is the valuation question in early stage investing. And there's no science to it. I mean, a lot of these numbers just get pulled out of a hat. I'm really curious your perspective, because it matters. The valuation matters. But from my vantage point, it's the old, I'd rather own 2% of something that's worth $1 billion than 80% of something that's worth zero. This is a tricky thing that comes up with founders, and they have these sort of outsized expectations sometimes on valuation. How much does it really matter, in your opinion, that discussion, and what's the optimal founder position? It would seem like they would balance it against the long term and the right partner and so forth, but I'm sure you've seen everything on this front.
Yeah. And I would say historically, I would have been more of a stickler in terms of, those lower valuations being a necessity. But admittedly, I grappled with exactly that question for a really attractive investment opportunity recently. I mean, I think you may have heard a common refrain out there, if valuation is the excuse not to invest. I mean, if valuation is the reason not to invest, it's a bit of an excuse. But then you do have to kind of step back and check yourself on some of the realistic outcomes and numbers. I mean, it's true in at the levels we're investing, we can be somewhere between 5 and 10% owners. And bottom line, I think that's right. Like, ultimately, we are underwriting to outcomes in terms of, return multiples. And so does this have a realistic opportunity to achieve a 10x? Bit of an arbitrary number. But, at least does it have some of that outsized return potential? And is a realistic exit expectation going to achieve that number? So, of course, in those valuation considerations, and this is an interesting point, and it's one of the things that's surprised me. I think, of course, the more we've gotten into it, and recent years have brought this into greater focus, there wasn't the nuance added to that. I think we've always had the feeling like, yeah, this shouldn't be a surprise, but we have to underwrite every investment opportunity, chart their path to growth. How much is that going to cost? How many more rounds and dilution could that potentially present? And is there going to be a realistic exit outcome that can achieve a 10x or even a return the fund opportunity? That argument could be made at some higher valuations, call it 30 to 40 million for some of these Series A opportunities. But there are plenty of opportunities that, you're not going to get to a positive answer there. But by and large, you're giving yourself a much better opportunity when you're investing, in somewhere in the teens in terms of valuation. But it's true. I think it's important for founders to really consider, like, you raise at those high valuations, you are essentially, this is generalization, but generally if you're raising like a $10 million round, you may in fact be essentially, agreeing that you're going to be aiming for $1 billion outcome. And that could present some liquidity challenges or future fundraise challenges when existing investors, may have a hard time participating, or because you can't find new capital. So Yeah, you can see where capital discipline and valuation discipline provide greater optionality for a lot of these companies.
Pete, I want to revisit something that you said offline, and it was an area I'd love to explore just a little bit more. And you mentioned that early stage VC is one leg of the stool. What did you mean by that, and where does it fit in the grand scheme of capital stack?
Yeah, thanks for remembering that. When we kicked off Trailhead, at the core, the mission was to move regenerative agriculture forward. And where we saw the greatest need, and that dovetailed with some of our collective experiences, was at the early stage. Some of that higher risk capital to really cross that valley of death and get some of these products out into the market. So with that ultimate mission in mind, there's full recognition, early stage venture capital is not the only capital source that's needed in this space. And the hope, again, given our varied experiences, is that Trailhead can be, a full stack capital platform for, all the capital needs of the companies that are operating in the space. So, when we say we are participating in the space, the initial question is, are you investing in, farmland and, related infrastructure? And we are not, but we are participating in companies that, can improve some of the operations at those levels. But ultimately, bringing in some more real asset capital could be of value. Although, honestly, at this point, there is a lot of capital in the space, and we've found a few companies to invest in that have unique angles there. But we've talked about later stage capital. There's a lot of merit to have, call it Series B or growth stage equity, and ultimately private equity, but with longer duration. And who knows, perhaps in a holding company structure where you get a little bit more permanent capital to give these companies the timelines they need, but to also have the flexibility to put to work the risk capital. So ultimately, the path forward for us would be filling out that capital stack.
So is there a private equity fund being raised on the horizon?
Not on the horizon.
Trailhead private equity?
There could be some considerations. Obviously, we wouldn't be the first ones to do it, but really the next step for us is proving out the strategy we've been pursuing with Fund 1. And honestly, in the coming months, we're going to start going out to the market for Fund 2, which is really a lot of copy and paste from Fund 1, but bigger. Right now we've got a $50 million fund, and Fund 2 would be expected to be about 75 to 100 million.
Great stuff, Pete. Well, listen, we could take this in like 100 directions.
Pat, I do have one last question now, because this is something that we're talking through this, we're covering a lot of ground.
My partner giving me the slap down. He's acting like he's acting like he's the boss. Pete, he forgot who the boss was here.
We talked a lot of many different things, right? We're covered today. And I always like to maybe end on, what question didn't we ask, but maybe we should have?
Good question.
Or we did such an amazing job, we covered it all. That's also an option, right?
Well, as you throw that out there, a few questions are coming to mind. You did do an awesome job and covered an incredible amount, and I did far too much talking to answer some of those questions.
You're way too nice to us, Pete. Thank you.
I do think about the questions along the lines of how do we really handle the needle we're trying to thread between concessionary and market-driven returns and big ag versus like regenerative purists, in both cases at opposite ends of the spectrum. Perhaps that's a little too nuanced for you and your audience, maybe not. But, I think it's important that, we have, we are absolutely pursuing market-driven returns. But when we initially started in the space, that was the initial impression. Regenerative agriculture is, that must be kind of, concessionary capital, meaning that you're going to be putting risk capital to work, but not expecting some of those bigger outcomes. But I think, fortunately, in recent years, the potential to achieve those market level returns and beyond has been validated. But then in the space and the parties that we're dealing with, with big ag at one end and, a little bit more regenerative focused players at the other, how do you deal with those? Some say, want to take a hard stand against big ag. I think we take more of an approach where we try to be bridge builders. We think that's kind of essential to the overall ecosystem. They're not going anywhere. In plenty cases, they are trying to improve operations. And I think they just need to be clearly educated and presented profitable opportunities to help move their business in that direction. And so, the regenerative agriculture opportunity should be clear in that there are plenty of examples out there where it is significantly improving profitability. That just needs to resonate and be clearly conveyed to some of the bigger agriculture players. So, it's one element we're trying to address.
It's great.
Well, now that we've stayed on for, I actually had another question, Pete, I wanted to bring up.
Yeah,
there you go. Yeah, good job.
Yeah.
So, listen, I want to hit on something that's kind of more on the personal side, going back to the beginning when you made the transition from PE to VC, kind of twofold. Where's Pete Oberle in 5 and 10 years? I know we can't predict, and you seem like you're day-to-day, very zen, live in the moment guy, which is awesome. But as best you can, where is this it? I mean, is this what you do the next 20 years and growing, adding to the capital stack potentially? That'd be the first thing. And then the second thing is you kind of threaded the needle a little bit of having this come to Jesus and took a year off, and then you kind of found your purpose and you combined it and you did some like moonlighting and angel investing. I think a lot of us and a lot of our audience out there in this day and age, it's like, okay, how do I not totally abandon what I know professionally and that I make money at, but how do I really make a transition, do something a little bit more entrepreneurial, but not crazy, and get the best of life and business? I'd love like 30 seconds, a minute from you on that.
Yeah. Well, to the first question about where do I see myself in 5, 10, 20 years? Yeah, I would say this is it. I keep kicking myself for not finding it sooner and figuring out this is the place to be. But of course, I guess we could all do that and hopefully ultimately conclude everything is meant to be and was necessary to get me to this place. And I guess some of those prior experiences added relative background and context. So we were having conversations yesterday about generational transitions, which is part, again, a generous consideration for us in that we need to do a lot more work to actually deliver results. But that's the plan. Sorry, I wasn't in the space sooner and excited to be in it for the decades to come. But to your question about how to, thread that needle and make the transition. Well, actually, okay, sorry. Could you repeat the question again?
Yeah, the question was, you left the PE fund, which you talked about partnership. But listen, you could have gone anywhere, I'm sure. But you said it wasn't the end all be in. You took some time. You went down this paleo thing. You're Mr. CrossFit. And ultimately, you found this other niche that's got some relation, but it's new. And how did you get there?
Yeah. Well, and, I'll fully recognize that I had some optionality. More than anything, because I didn't have any obligations. I was single and without kids at the time. So that definitely freed things up. And I had low living standard expectations. So money could go far. But that said, I think some of the learnings from leaps taken apply to everybody. And I think, fortunately, there's a lot of content and brilliant people out there sharing some of that encouragement. And that is, what's holding so many of us back from making some changes and transitions like that? It's it's fear in a lot of respects. Fear that, what you're doing may seem crazy or questionable to a lot of the folks that you're working with. But of course, more practical, the fear that you may not be able to provide for yourself or your family if you make that change. Understanding those factors have to be considered. I have been incredibly encouraged by the relative low risk that it requires to make a change like that. Again, things have changed in recent years, and it's important to differentiate in, call it the startup or venture capital scene in general, there are continuing tailwinds in broader climate tech, and regenerative agriculture can fall under that climate tech umbrella. But with all of the resources out there, just in terms of job opportunities, in terms of networks and communities willing to help one another, I think the collective resources go a long ways into mitigating risk of making a change along those lines. And I mean, maybe that goes back to your question of how I landed on where I did. Again, at less capital risk, personal capital risk at work, but I landed on what felt like a win-win opportunity in that, like, okay, maybe if we move forward and for whatever reason it didn't work out, I'm going to be putting everything I possibly can into it. And I believe strongly enough in the opportunity that it's going to move the ball forward for something, that's very important and that I truly believe has the potential to improve health, planetary and human health.
Love it. You're the man, Pete. You were the man. You continue to be the man. So, hey, man, we're really
everything is advertised, right, Pat?
Gracious for you spending some time. This was awesome, man. And it's I'm glad we reconnected. It's been a long time, but I wish you all the best at Trailhead Capital, and you're a good man. So thank you.
Thanks, guys. Great speaking with you, and definitely look forward to doing it again sometime.
Okay, and Pete, remember, BizMafia is what?
Where business gets made.
Great. Thanks everybody. Pete.